Hello, and welcome to the first installment of a new monthly series titled Asking for a Friend. I'm your host, Eric Jefferson, managing partner with TrustleBridge Capital. And in this series, my plan here is to answer timely questions that have come in, whether it's respect to capital markets, to changes in tax code, financial planning techniques, anything that is front and center to you or a friend that you know, based on what you've heard in the news or read in an article. Would invite you to please send that over to us. Happy to spend some time dissecting that, offering some further clarification. Again, if it's something that's relevant or on the top of your mind, likely is for others as well. And again, would encourage you, please send those to us so we can share that on a broader scale. For today's focus, I want to dive into the relationship between interest rates and the negative impact that they have not only on stocks, but particularly growth stocks. And I'll talk about what separates growth versus value in just a moment. To get started here, I do have a quick note just to keep the lawyers happy. And to kick things off, I want to start with one of the fundamentals of investing. There's a quote Warren Buffett shared years ago that in essence boils down investing to a cash outlay or a outflow, an investment today in exchange for future earnings. And so to illustrate that point, I want to share two examples here. Obviously, this is a hypothetical, but let's say that you had $100 to invest today. You're examining two different companies. Company A, more of a value type organization, very established company in a market where they capture a good bit of wallet share. Their focus is really on operating that business, continuing to maintain it year over year. And in contrast, we have Company B, which is more of a growth organization. I think these are a lot of the technology startups. These are companies that take every extra dollar left over at the end of the year, reinvest that back into the business, into hiring more workers, into buying more technology, more facilities, so they can continue to grow and scale. And as we boil down the cash flows, again, one of the fundamental principles of investing, when we think about how capital is ultimately returned to investors. Company A, again, more that established company, their focus is really on maintaining their margins as opposed to growth. In this example, hypothetically speaking, of course, Company A pays a $10 dividend each year, every year. You see that illustrated here for the next decade. And then at the end of that 10-year period, reasonable expectation that that company could be sold for $125. So when we think about the cash flow, obviously those dividends are occurring each year and every year for the first decade. Total amount earned on that investment would be $225. Now, in contrast, Company B, again, more that growth engine. Every year they have leftover monies, those get reinvested, trying to continue to grow and scale. In contrast, they don't pay a dividend in any of the first 10 years, but at the end of that 10-year period, you reasonably believe you could sell that company for $235. And so when we look at the same $100 investment today, Company A, granted, returns more capital earlier on, results in a total amount earned of $225. Company B is all at once at the end, but you're generating an additional $10 in profit. The question then becomes, which investment is more attractive? And if interest rates are at zero, the answer is very clear. Company B pays you an additional $10 in profit. If you're not worried or thinking, incorporating about interest rates, that is clearly the better option. However, one thing that calculation ignores is the time value of money. And Company A, that value company, pays a set dividend of $10 a year. If we think about interest rates not being at zero, by getting a return of that capital sooner, $10 each year, every year, an investor would have the option to invest those dividends in the risk-free rate. That would not change the risk of their overall investment, and by doing so, have the opportunity to generate excess return. So since interest rates typically aren't zero, to account for this, Wall Street analysts will often compare companies based upon the expected present value of future cash flows. In essence, what that does is it looks at what are the cash flows across future time periods, discounts them back. So in essence, divides by that risk-free rate to understand what is the value of those future cash flows in today's terms. Now, this speaks to a concept virtually everyone is familiar with, the time value of money, which suggests $1 today is worth more than $1 tomorrow, because in essence, $1 today could be invested in that risk-free rate to generate excess return. So now let's go back to that example and assume, hypothetically speaking, that interest rates are 2%. Company A, as we saw, pays a total amount of $225. 100 of that is paid in a series of installments the first 10 years, within that terminal value of 125. If we discount each of those cash flows back by an interest rate of 2%, that generates a present value of those future cash flows today of $192. So one way to think about it is, if interest rates are at 2% today, that is your cost of a risk-free investment. When you have the option to invest $100 in company A, you would reasonably expect that the present value of that investment over the next decade would generate you $192 in profit. Now, in company B, again, the growth company did not pay a dividend for the first 10 years. However, you got a slightly larger terminal value of the 235. If we discount that 235 over a 10-year period, interest rates at 2%, interestingly enough, we actually get to the same present value today, $192. So in this example, if interest rates are at 2%, when you're considering both of those options, although company A will in essence pay you less overall, you have the opportunity to reinvest those $10 dividends for the first decade, generate excess return that's going to equate to the same end present value today. Now, let's say hypothetically, though, that interest rates increase significantly from 2% to 5%. While a move overnight of that magnitude would be truly historic, we have seen that year to date, where interest rates January 1st of this year went from virtually zero to where they are in the mid to upper threes. And so in that same example, let's now consider those two options, but this time using an interest rate of 5%. When we discount those future cash flows for company A, present value of those future cash flows using the 5% discount rate translates to a present value of $153. You'll see that is $39 less than the original present value of $192, which represents a 20% decrease in the present value of that stock. Again, way to think about it would be, interest rates are at 2%. We invest $100 today. We would expect to earn the future equivalent of $192. With interest rates now at 5%, a $100 investment today would generate us $153 in profit. Company B, though, again, no return of capital in the first decade. We now take that 235 figure at year end, at the end of that 10-year period, discount now by 5%. The present value of those cash flows today is now only worth $144. That is $48 less than the $192 that it was at 2%. You'll see that that represents a 25% decrease in the present value today. So again, as we think about the stock market year to date, interest rates have skyrocketed. That impact has been felt on all segments of the market, but especially in the growth world, where again, being those cash flows are so further down the road, and also in many cases not as guaranteed, having a higher discount rate, a higher risk-free interest rate decreases the present value of those. And that is largely in part why you've seen those growth stocks come under a great deal of pressure in the environment today. That's all for now. I want to thank you for joining us for the first installment. And again, please consider this your invitation. Submit any questions that either you or a friend of yours may have on their mind based on what they're seeing, hearing, and reading. Love the opportunity to be able to dissect that in more detail and share that with the group. Thanks again for your time. Have a great rest of the day.